Welcome to the Deep Dive. We're here to sift through the noise, all the market intelligence, the research, the raw data, and pull out the insights that matter for you. Today, we're really digging into September 25th, 2025. We've got the briefing right here. And this day, well, it was something else. It perfectly captured this totally counterintuitive dynamic we see sometimes. The whole good news is bad news thing.
Yeah. It's a head scratcher on the surface, isn't it?
Absolutely. All the signals about the U.S. economy that Thursday, they looked strong, resilient, should have been reassuring, right? But nope, those very reports kicked off one of the biggest market slides we'd seen in a while.
And that's what we're unpacking today. For you listening, this is really about getting under the hood of risk repricing. How does a market so hooked on policy react when the economy doesn't play along? We'll connect the dots, show why that strong economic data was seen as, well, a threat to valuations.
The threat specifically because it messed with the Federal Reserve's plans, right?
Yeah, exactly. It suddenly looked like the economy was maybe too strong for the Fed to keep cutting rates like everyone expected.
Okay, so that's the core question we need to answer. How did these solid economic reports, the kind that usually make investors cheer, trigger the biggest three-day percentage drop for the S&P 500 and the NASDAQ since that little dip back in August 2025? It's this paradox, economic strength becoming the market's worst enemy. Let's figure out why fundamentals seem to be taking a back seat right now. All right, let's start with the damage assessment. This wasn't just a one-day blip. U.S. stocks extended their losses for a third straight day on that Thursday, September 25th.
Yeah, 3 days running. That shows real conviction in the selling. It wasn't just a knee-jerk reaction. It felt like a fundamental shift in sentiment. Risk aversion was definitely the name of the game.
Let's look at the closing numbers. They paint the picture pretty clearly. The Dow Jones Industrial Average, it fell 171.50 points. That's a 0.37% loss, closing at 46,121.28. Not catastrophic maybe, but it confirmed the downward trend.
Right, and the broader market showed it wasn't just a few big industrial names struggling. The S&P 500 lost 33.25 points, down 0.5%, closing at 6,604.72.
But the real pain, as often happens when we talk about interest rates and Fed policy, that was in tech, wasn't it?
Oh, absolutely. The NASDAQ Composite. That index felt the most pressure. It closed down 113.16 points, also 0.5%, finishing the day at 22,384.70.
So 0.5% across the board for the S&P and NASDAQ.
Yep. And when the perceived cost of money goes up or the expectation of future cuts goes down, those high-growth tech stocks, they get squeezed first. It's almost mechanical. We'll definitely dig into that discount rate effect later.
Okay, but here's the kicker. The context that makes this sell-off feel so sharp. This wasn't the market bouncing off a bottom. This three-day slide knocked the S&P 500 and the NASDAQ 1.33% and 1.77% respectively off their all-time record high.
Brand new record highs.
Exactly. Set just 3 days before, on Monday, September 22nd. So we were flying high, basically priced for perfection based on one key assumption.
That the Fed was going to keep cutting rates.
And that assumption got shattered.
It really did. And this negative reaction to genuinely good economic news, it just lays bare this deep-seated vulnerability in the market. It's this dependence, almost an addiction, to easy money, to accommodative monetary policy.
We've seen this playbook before, haven't we? Post-2008, then again in 2020.
Right. Central banks step in, flood the system with liquidity, slash rates to zero or near zero. That keeps the cost of capital artificially low for a very long time. Over a decade, really.
Which leads to some interesting investment decisions. Maybe not always the most efficient. Some call it malinvestment.
That's one term for it, yeah.
Yeah.
Capital flows where money is cheapest,
Yeah.
not necessarily where it's most productive long term. And that rally we saw just before this slide, it was entirely built on this narrative, this belief that the Fed had made a dovish pivot.
Everyone assumed the rate-cutting cycle was locked in.
Pretty much. The rates would keep falling through 2025. That expectation acted like a kind of safety net, inflating valuations across the board. Housing, tech stocks, you name it.
So when we talk about this market dependency, we're saying asset prices are now reacting more to the Fed's interest rate decisions than to say how much profit companies are actually making or how fast the economy is growing.
That's the crux of it. It's the heart of this paradox. A strong economy used to be unequivocally good news for stocks. It meant higher earnings, higher dividends.
Yeah.
But now it's seen as a threat because it means the Fed might have to tap the brakes on rate cuts or even, pause them altogether.
Okay, break that down a bit more. Why has this dependency become so extreme? We're basically saying the market shouts, forget higher profits today, just tell us borrowing money gets cheaper tomorrow.
Well, think about valuations. After years of low rates, they got stretched. The average PE ratio on the S&P 500 already had those future rate cuts baked in. Lower rates make future earnings look more valuable today, justifying those higher prices.
Right.
So when strong data, like that surprise GDP revision, hits the tape, it suggests the Fed might have to stick with higher for longer rates. Suddenly, that justification for high PE ratios, it just vanishes. Poof.
And the foundation looks shaky.
Exactly. The foundation is revealed to be less about solid earnings growth and more about this policy expectation, which can turn on a dime based on a few economic reports.
So if the economy keeps running hot and the Fed has to rethink its easing cycle,
Then that main pillar supporting current market valuations gets kicked out. And the market has to do a reset, a repricing of risk, which can be painful, obviously. That 3-day drop we saw, that was the market doing that recalculation live.
okay, let's get to the scene of the crime. What specific economic reports landed that Thursday and just completely changed the mood? It wasn't just one thing, was it? It felt like a triple whammy of strength.
It really was a confluence of factors.
Hmm.
But the biggest shockwave, I think, came from the final revision to the second quarter 2025 GDP numbers. It got revised up, and sharply, to an annualized growth rate of 3.8%.
3.8%. Wow. And what were people expecting?
Well, the consensus was closer to the previous estimate, which was around 3.3%. So, jumping half a percentage point like that, it might not sound like a huge amount, but for the entire U.S. economy, it points to much stronger underlying momentum than anyone really anticipated.
And what was driving that big upward revision? Was it business investment or?
It was largely the consumer. Personal consumption got revised up significantly. It was shown growing at a 2.5% pace.
Okay, and the expectation?
List rose at a 1.7%.
Oh.
So a big jump there, too. It showed a consumer who was still spending pretty aggressively, not really feeling the pinch yet from the higher interest rates the Fed had already put in place.
And that's the good news is bad news part, right?
Precisely. A strong consumer keeps spending, which is great for businesses in the short term, but it also fuels inflation. The Fed wants to see the consumer slowing down a bit to help cool inflation and engineer that soft landing they're always talking about.
But this GDP report showed the opposite, spending accelerating.
Exactly. Which makes the Fed's job much harder. It raises the risk that inflation could flare up again if they cut rates too soon or too fast.
Okay, so GDP was the first hit. What came next? Labor market.
Yep. We got the initial jobless claims report for the week ending September 20th, and those numbers, they plunged. Surprisingly so, down to 218,000.
218,000,
Yeah.
and expectations were higher.
Considerably higher. The consensus was around 233,000, and the previous week was 232,000, so big drop.
Which basically killed any hope that the job market was finally starting to cool off.
Pretty much. It poured cold water on the idea that labor market weakness might start easing wage pressures. When claims drop that low, it means layoffs are minimal, companies are holding on to workers. The market is still exceptionally tight.
And a tight labor market means?
Continued pressure on wages. And wage growth is a major driver of services inflation, the sticky kind the Fed worries about most. If wages keep rising strongly, it makes it very hard for the Fed to get inflation back down to their 2% target sustainably. This report suggests they weren't making enough progress cooling things down.
Okay, GDP revision up, jobless claims down. What was the third piece? Durable goods.
That's right, core durable goods orders for August. These measure business investment in long-lasting items, stripping out volatile transportation orders. They came in at plus 0.4% month over month.
And the expectation there?
Was actually for a small contraction, minus 0.1%, so beating expectations by 0.5%. This showed businesses were still investing, still confident, despite higher rates.
So you put it all together, strong consumer spending, a super tight labor market, solid business investment. It's a picture of a robust economy.
Uncomfortably robust from the Fed's perspective, and definitely from the market's perspective, which was betting on weakness.
So this data dump basically handed ammunition to the Fed members who were already worried about cutting rates too quickly, the hawks.
Absolutely. Think about someone like Chicago Fed President Austin Goolsbee. He had already been publicly warning about inflation risks if they eased too aggressively. This kind of data strengthens his case significantly. It makes it much harder for the doves on the committee to argue for rapid rate cuts.
And the market instantly got the message. The thinking shifted from how fast will they cut to, uh-oh, will they cut at all?
Exactly. The odds shifted. And that forces an immediate repricing across asset classes. Bond traders started selling treasuries, pushing yields higher. We saw the 10-year treasury yield tick up, maybe just 2 basis points initially, to 4.17%, but the direction was clear.
This doesn't sound like much, 2 basis points.
It's not huge in isolation, but it represents the changing expectation for the cost of risk-free borrowing. If the market starts believing rates will stay higher for longer, it impacts everything. Corporate borrowing costs go up, refinancing gets more expensive.
Which hits profits down the line.
Right. So that strong economic news, paradoxically, creates a financial headwind because of what it implies for future Fed policy. The good news became the bad news right before our eyes.
Okay, now let's get into the mechanics. This kind of shift doesn't just mean selling, it means money moving around. Sector rotation. Where did the money go? Who is selling what?
Well, first, let's be clear. This is a broad-based risk-off move. The market breadth numbers confirm it wasn't just a few big tech stocks dragging things down. On the New York Stock Exchange, the decliner to advancer ratio was pretty stark, 3.48 to 1.
Wow. So for every stock that went up, nearly 3.5 went down. That's widespread selling pressure.
It is. It signals investors are genuinely reducing risk, moving towards safety, maybe even just raising cash. And it was even more pronounced on the NASDAQ.
The tech-heavy index.
Yeah. There, the decliner to advancer ratio was a brutal 4.42 to 1. So over 4 losers for every winner. That really tells you the selling was concentrated in those growth-oriented areas, but the overall sentiment was definitely negative across the board.
All right, let's talk specific sectors. Who are the winners and losers in this rotation? There weren't many winners, I gather.
Very few. The standout top performer was energy. That sector actually managed to rise 1.2% on the day, bucking the trend.
Okay, why energy?
Yeah.
In the middle of a sell-off.
It benefits from a couple of angles here. First, cyclically, the strong economic data we just talked about, robust GDP, suggests continued demand for oil and gas. So that's supported.
Makes sense.
But maybe more importantly, in this specific context, energy often acts as an inflation hedge. When strong data fuels fears of rising or persistent inflation, money tends to flow into real assets, things you can touch, like commodities.
Yeah.
Energy stocks offer that exposure. Their profits are directly tied to energy prices. Plus, they're seen as more of a short-duration asset compared to tech.
Okay, short duration versus long duration. We'll get back to that. So energy was up. Who were the bottom performers?
Materials took a big hit, down 1.6%. And technology, as we saw from the NASDAQ breadth, was also under significant pressure.
Anything specific dragging down materials besides the general risk-off mood?
Yeah, there was some company-specific news compounding the problem. Freeport-McMoRan, SCX, the big copper and gold miner, plunged. There was news about a mudslide impacting operations at their massive Grasberg mine in Indonesia. That adds a supply disruption worry on top of the broader macro concerns for materials demand.
Okay, but the bigger story, especially for understanding this whole dynamic, is technology. Why does tech get hit so hard when rate expectations shift? You mentioned Oracle, NVIDIA, Alphabet, Meta, all falling.
Right. This comes down to that discount rate mechanism we touched on. It's the core financial math driving this rotation.
Let's really unpack that. Explain how rising bond yields translate into lower tech stock prices. What's the connection?
Okay, so when the market expects interest rates to be higher for longer, the yield on safe investments like the 10-year Treasury bond goes up. That 10-year yield is basically the bedrock, the foundation, for calculating something called the discount rate.
And the discount rate is used to figure out what future profits are worth today.
Exactly. It's the rate investors use to translate expected future cash flows profits earned next year, or 5 years, or 10 years from now back into today's dollars. It's how you determine the present value.
So higher discount rate means future money is worth less today.
Precisely. And this disproportionately hurts certain types of companies. High-growth technology stocks are often called long-duration assets. Why? Because a huge chunk of their current valuation isn't based on the profits they're making right now, but on the massive profits investors expect them to make far out in the future, maybe 5, 10, even 15 years down the line.
Their value is heavily weighted towards the distant future.
Correct. So think about a software company projecting huge earnings starting in, say, 2030. Even a small increase in that discount rate today, when applied year after year to those distant 2030 earnings, it dramatically reduces their present value, much more so than for, say, a mature utility company that generates steady cash flow right now.
I see. The further out the expected profits, the bigger the hit from a higher discount rate.
You got it. So when investors saw that strong economic data and the 10-year yield started climbing towards 4.17% and maybe looked like it could go higher, they immediately recalculated. The price they were willing to pay for those far-off tech earnings suddenly looked too high. It's a rational adjustment.
So the selling in tech wasn't just panic, it was math.
A lot of it is math, yes.
Yeah.
It's a mechanical reaction. Selling long-duration assets, like high PE tech, and rotating into shorter-duration assets, like energy or maybe some value stocks, whose worth is based more on current earnings.
And this rotation, if higher for longer really sticks, could be more than just a one-day thing. It could signal a bigger shift in market leadership.
It certainly could. If this environment persists, we might see value stocks, the ones generating profits now, outperform growth stocks for a while. It's a potential thematic change investors need to watch closely.
All right, so the big picture was risk-off, driven by macro data and Fed fears. But digging into individual company news from that day, September 25th, reveals a more complex picture, right? Some conflicting signals, especially about the consumer.
Absolutely. While the macro tide was pulling almost everything down, the micro-level stories, the individual company reports and news, provided really important nuances. You couldn't just paint everything with the same brush.
Let's start with a big one that seemed to directly contradict that strong GDP consumer spending number we talked about. CarMax, the used car retailer. What happened there?
Oof. CarMax, KMX, got hammered. Its shares tanked 11.15% in pre-market trading alone, and during the actual trading day, they fell as much as 22.3%. It hit a 5-year low.
A 5-year low? That's brutal. What caused that collapse?
They missed on earnings and revenue estimates.
Right.
A pretty significant miss, apparently. And this immediately raised red flags about consumer demand, specifically for big-ticket discretionary items.
Like used cars,
Yeah,
which are often financed.
exactly. So while the overall GDP data showed strong aggregate spending, the CarMax results suggested that maybe the part of the consumer that relies on financing for large purchases is really starting to feel the pain of higher interest rates.
So it's like a split consumer. Maybe folks are still spending on services or smaller items, but pulling back on major purchases that require loans.
That's the implication. The CarMax news served as a real counterpoint to the GDP report. It suggested the Fed's rate hikes are biting, but perhaps more selectively, hitting rate-sensitive sectors hard while overall spending stays buoyed by other factors. It muddied the water, for sure.
Okay, so CarMax was a big negative signal on the consumer. But then on the other hand, we saw continued strength in certain themes, right? Like AI.
Yes, that was the other side of the coin. Accenture, ACN, the big consulting giant, actually rose 1% in pre-market after beating expectations.
And they credited AI demand.
Largely, yes. They pointed to strong demand for their AI consulting and implementation services. This was a really interesting data point because it showed that even within the tech sphere, which was getting hammered overall by rate fears, a powerful secular growth theme like AI could still provide buoyancy for individual companies.
So businesses are still investing heavily in AI, even if the broader economic outlook or rate environment gets tricky.
It seems so. It suggests that AI spending is seen as strategic, maybe even essential, and companies are prioritizing it. That theme proved resilient enough, at least for Accenture that day, to overcome the broader sector headwinds.
Interesting. Any other standout tech stories? It wasn't all negative despite the Nasdaq's performance?
There was one notable bright spot, Intel, INTC. Its stock closed up over 2%.
Intel, up 2% on a day like that for tech. Why?
There were reports circulating that Intel was in talks with Apple about potentially securing a major strategic investment from them.
Ah, okay. So company-specific M&A or strategic partnership buzz?
Exactly. That kind of news, suggesting a potential major boost or realignment in the crucial semiconductor industry, was powerful enough to lift Intel's stock even while most other tech names were sinking. It shows that unique corporate catalysts can still matter, even in a tough macro environment.
But not all tech giants escaped. You mentioned Oracle earlier.
Yeah, Oracle, or SCL, had a rough day, sliding somewhere between 4 and 5%. It felt like a confluence of factors hitting them. The general tech weakness, sure. Maybe some profit-taking after its own recent run-up linked to AI excitement.
And wasn't there news about debt?
Yes, that too. News came out about an $18 billion debt raise they were planning, raising a large amount of debt right when interest rate expectations are rising. That's not usually something investors cheer about. It just added to the pressure.
And there was another layer of uncertainty hovering over everything, wasn't there? Something about Washington.
Ah, yes. The looming threat of a potential U.S. government shutdown. Reports surfaced that the White House Budget Office was telling federal agencies to start preparing for one.
Which just adds another layer of risk the market hates.
Exactly. It's not just political drama. A shutdown disrupts government spending, delays contracts, hurts economic activity, and crucially, Right now, it could delay the release of vital economic data.
Like the inflation report everyone was waiting for.
Precisely. Operating without that key data, that really increases uncertainty and potential volatility for markets. It's just another negative weighing on sentiment that day.
Okay, so a really mixed bag on the corporate front. Accenture and Jabil beating pre-market, CarMax missing badly, which set the stage for the after-hours earnings, right? All eyes were on one particular retailer.
Absolutely. Everyone was waiting for Costco, COST. They were due to report after the closing bell. The anticipated earnings per share was around $5.81.
And why was Costco so critical at that moment?
Because of those conflicting signals we saw, you had the strong overall consumer from GDP, but the weak big-ticket discretionary spending from CarMax. Costco sits somewhere in the middle, right? It's a bellwether for a huge swath of middle to upper income consumers.
So their results and what their management said about customer traffic, what people were buying, any signs of margin pressure, that would provide a much clearer picture.
Exactly. It was seen as potentially clarifying whether the CarMax weakness was an isolated issue or a sign of broader consumer stress starting to emerge. A lot was riding on that Costco report heading into Friday.
So as that turbulent Thursday trading session closed in the U.S., the negativity wasn't just contained here, was it? It seemed like global markets were feeling the same anxieties.
That's right. The U.S. sell-off echoed what was happening or had happened overseas. European markets like the DAX in Germany and the CAC in France were broadly lower. They fell about 1% or so.
Reacting to the strong U.S. data, too, figuring it might mean their own central banks stay tighter for longer.
That was likely part of it, yes. A synchronized concern about sticky inflation and the policy response. And we saw signs of inflation bubbling up in Asia as well. Japan, for instance, reported an acceleration in its producer price index for services.
Another sign of those persistent price pressures globally.
Exactly. It all fed into this narrative that maybe inflation wasn't quite beaten yet, making central banks hesitant to ease policy too quickly.
And this caution was immediately visible in the futures market, even before the next U.S. trading day began.
Oh yeah, futures contracts for all three major U.S. indices were pointing lower heading into Friday morning. S&P 500 futures were down about 0.5%, NASDAQ 100 futures off maybe 0.6%.
So traders were already pricing in a lower chance of Fed rate cuts based on Thursday's news flow.
Instantly, the market adjusted its probabilities right away, which leads us to the absolute main event, the focal point for everyone heading into Friday.
An inflation report.
The big one. Friday's release of the August Personal Consumption Expenditures Price Index, the PCE report.
And remind us why this inflation report is so important, more so than the CPI even.
Because it's the Federal Reserve's preferred measure. It's the one they officially target, especially the core PCE reading, which excludes the volatile food and energy components. The Fed believes it gives a better read on underlying inflation trends.
So the stakes for this PCE report were incredibly high after Thursday's strong data.
Immense. Thursday's news, the hot GDP, the strong consumer, the tight labor market, it significantly ramped up fears that this PCE report, especially core PCE, could come in hot.
Meaning higher than expected, showing inflation isn't cooling fast enough or maybe even re-accelerating.
Exactly. A hot reading would basically confirm the hawks' fears. It would give them concrete evidence that underlying inflation is still too sticky, fueled by that robust demand we saw.
And if that happened?
It would pour cold water on any remaining hopes for more rate cuts in 2025. The market would likely price them out almost completely. You'd probably see bond yields jump higher again, and stocks could easily take another significant leg down.
But there was an upside scenario too, right? What if PCE came in soft?
Well, that would be the dream scenario for the market at that moment. A softer than expected reading, especially on the core number, would be huge. It would suggest that maybe the economic strength isn't inflationary after all.
It would validate the Fed's plan to ease.
It could, yes. It would give the doves some ammunition back. It might calm fears, bring yields down, and potentially spark a sharp relief rally in stocks. It just shows how hyper-focused and sensitive the market was to this single data point.
Okay, so PCE was the main event. What else was on the immediate calendar that investors were watching?
Well, also on Friday, we had the final reading for the University of Michigan Consumer Sentiment Index for September. Important, but secondary to PCE. Then looking ahead to the following Monday, the Chicago Fed National Activity Index for August was due.
So more pieces of the economic puzzle coming out.
Right. Every piece of data was suddenly under intense scrutiny. and amplified, as we mentioned, by that government shutdown risk hanging in the background.
Because a shutdown could delay these very reports.
Correct. Delaying key data releases just injects more uncertainty, more anxiety. Investors hate flying blind. It forces them to guess, which often leads to more volatility. It was really tense setup heading into that Friday PCE report. #tag outro. So let's try and synthesize this. What does Thursday, September 25th really tell us? I think it was just a stark, almost brutal illustration of the core tension driving markets right now.
Which is?
It's this fundamental conflict. On one hand, you have a surprisingly strong, resilient U.S. economy. Objectively, that should be good news. But on the other hand,
You have a market that got way ahead of itself, priced for perfection based on the idea of nonstop monetary stimulus. Easy money forever.
exactly. And the strong economy directly threatens that easy money narrative. So good economic news becomes bad market news.
And the consensus view, looking back at that 3-day pullback, is that it wasn't necessarily irrational panic.
No, I think the consensus, and the mechanics bear this out, is that it was a rational repricing of risk. The market was forced to confront the very real possibility of higher for longer interest rates, maybe much longer than anticipated just days earlier.
So the takeaway for investors is stop hoping for rate cuts to bail you out and focus on actual company quality. Valuation matters again.
That seems to be the message, yes. The era of bad news is good news because the Fed will save us is being seriously challenged by economic reality. Fundamentals, quality, valuation, those probably need to come back to the forefront.
And we definitely saw that thematic shift playing out in the sector rotation.
Clearly. Money flowing out of those long-duration growth stocks, especially tech, and into shorter duration, maybe inflation-hedged areas like energy, potentially value stocks more broadly. Understanding that rotation is key because it might define market leadership for the rest of the year if this dynamic holds.
Which brings us to our final thought for you, the listener, to chew on. We know the strong economy is pushing back against the Fed's easing path. But what if that upcoming PCE inflation report, the big one, actually comes in surprisingly soft?
The counter-signal.
Right. If we get that soft inflation print, does the market's deep-seated dependence on easy money just immediately take over again? Does that ingrained policy addiction override the reality of underlying economic strength, triggering a massive relief rally?
Or has the spell been broken? Will the market now recognize that a resilient economy, even with one soft inflation report, ultimately means rates probably won't go back to zero anytime soon? Will that force a deeper, more structural rethink of those high valuations regardless?
Policy dependence versus fundamental reality, that feels like the inflection point.
It really does. And the market's answer to that question in the coming weeks and months will likely set the tone for everything else.
Lots to think about.
Indeed. Until our next deep dive, keep watching those numbers, keep questioning the narratives.